Let's talk about the scariest thing I read this morning. Morningstar said that 45% of Americans will run out of money during retirement. 45% of Americans will run out of money during retirement. I have to tell you that that was my fear. When I was 30 years old, I lost 100 and I don't know, 80,000 bucks or something like that. I was afraid that I wouldn't have any money in retirement. That was the fear staring me in the face at 30 years old. That was the fear that I had when I created the goal of getting to 4 rental properties. You heard me talk about 4 rental properties in my book, One Rental at a Time. You hear me talk about it all the time because I want you, and I wanted for myself, options. The idea of getting to 4 rental properties, starting at 30 is by the time you get to be 65, my grand vision is they would be paid off and I would have options. Now, what's not really said in that story is my grand plan was to continue working for 35 years, right? 30 years old. My grand plan was to continue to contribute to my 401k, right? Always get the company match. And that when I got to be 65, I would have, a 7-figure 401k and I would have a 7, maybe even multiple 7-figure real estate portfolio. That was my grand vision for a better retirement. And I think that vision, because of that concern at 30, would have really given us options. Now, obviously, the story morphs from there. I exit at 45. You know the story from there. But I really do believe, if you are working the 40-40 life, right? 40 hours for 40 years. If you complement your 401k or, IRAs or whatever you're investing in with 1, 2, 3, 4 rental properties, and you let somebody else pay it off, you get leverage on the, the down payment, assuming it cash flows, always has to cash flow. You're going to have options. And man, when I read this, 45% of folks, are going to run out of money. And I got to tell you, I think that gets worse from here. I think historically we've had pretty low inflation. I think inflation's going to, average closer to 2.5%, 3% for the foreseeable future, unlike the below 2%. So this probably only gets worse from here, right? I see no downside in contributing to a 401k, getting the company match, doing that for 35, 40 years, and getting a couple of rental properties. I don't see that being a negative. But yeah, that's frightening. 45%. That's just crazy. I don't know if you had a chance to watch yesterday evening's video. I had the pleasure of interviewing Andrea. Andrea is the #1 real estate investing school on school. Turns out Andrea is a powerhouse. I did not know what I was getting into when she said yes to the interview. But go and watch it because this is her story in a nutshell. Andrea was in Venezuela. She went to school in Venezuela to become a doctor. She became a doctor. In fact, she became a general surgeon. She realized that Venezuela government economy was not going to be what she wanted long term. So she left Venezuela and moved to the United States. But in the United States, she's no longer a doctor or a surgeon. She becomes a nanny. She takes any job that she can get because it was a better future. Think about that, right? You go to school in a country, you get the job you always dreamed of. You've made it, and you realize that the government, the economy is not for you. And then she, has to, change careers. And she became a nanny and some other things. You go ahead and watch it, but ultimately she does get married again, or gets married, and her and her husband built a real estate portfolio of a couple hundred units, and she does a lot of teaching and whatnot. I think there's a lot there. I'll have to interview her again. Again, I reached out to her because of what she's doing on school. But yeah, if you, especially if you're Spanish speaking, all of her content is in Spanish. She has a great story. Much respect to Andrea for doing those things. We have got some earnings out. Again, we're getting a lot of bank earnings early. We got Goldman Sachs beat top line, beat bottom line. Citigroup, same thing. Bank of America, same thing. State Street, same thing. Charles Schwab and PNC, same thing. So as of right now, we're seeing financials really across the board beat top line, beat bottom line. Charles Schwab was interesting. They have $9.92 trillion in customer assets. That's up 27% year on year. Wild. 9.92 trillion. PNC was interesting again. I wasn't really concerned about the big boys. I was concerned about the State Streets, the PNCs, that kind of level. PNC had a 65% revenue surprise. So, yeah, as of right now, financials are doing great. They're managing a lower rate environment. They are reserving for bad debt. They are having charge-offs. This is just the slow unwinding. We'll see if they can continue that. United Health Group, a non-bank, did report today. They beat top line, missed bottom line, which means earnings, missed earnings, and had a weak forecast. Their forecast for the following quarters was below expectations. We did get one economic report today, and it was nasty. New York manufacturing last month was positive 11, meaning growing. Was expected to be positive 3, meaning still growing, but less so. Came in at a negative 11.9. Let's call it negative 12. That is a gigantic downshift in a single month. Last month proving to be a blip. Last month was the first positive month, I think, in 6. So we can throw that out the window. We are back to negative months on New York manufacturing. Again, I think this is just a sign that across the board, consumers, businesses, just everybody we want to get this damn election behind us. We want to finish 2024. We want to have a better 2025. It just feels like everybody is we want to get this thing over. I think it's 3 weeks from now, and we will. We'll get this behind us. Don't forget, I voted. So I can complain. I always say, if you vote, you can complain. If you don't vote, then you can't complain because you didn't vote, which of course isn't true because people like to complain anyway. I'll pick it up later. So we got some other announcements. We got some Fed presidents speaking. Who do we have? Christopher Waller was the one that spoke yesterday. Christopher Waller. The Fed could pause if inflation unexpectedly rises. No kidding, Chris. That's some of the times they say things. It's like, really? Do we have to say that out loud? Next up, Fed can front load rate cuts if inflation falls and job market deteriorates. I think that's really setting us up for more 50s. And then lastly, rate cuts will be caution given latest data on inflation. So again, what I think they're trying to tell us is there's no rush to cut, but if things get bad, they will. I'm actually looking forward to Thursday's weekly unemployment claims. Remember last week, folks, it jumped to 250 something, 255. We might see some hurricane impact. There's a chance that Thursday's unemployment, weekly unemployment jumps again. And those might be the things that the Fed looks at and brings back the chance of a 50 in November. So we shall see. What else do we got? Ed Yardeni talking about the Fed being done. Ed Yardeni was on CNBC talking about the economy growing, earnings growing, no need for a rate cut. He thinks it's one and done for 2024. Again, I'm seeing a lot of people start to talk about not only skipping November, but also skipping December. It just doesn't feel, the economy appears to be weakening more than the kind of employment numbers look at. I think we get retail sales on Thursday, might get on Wednesday, tomorrow. Really going to be interested in retail sales because, look at that New York manufacturing number. So it's just, it just feels like everybody's pulling back, in my opinion. Logan from Housing Wire out with a great article talking about there is empirical evidence about what interest rate brings back demand. Logan has done some research over the last 2 years, and highlighted that rates sub 6 brings back marginal demand, again, to help absorb supply. Obviously, today, I think we're still sitting at 6.6 or 6.5. But yes, folks, if you want to know when demand will pick up, rates sub 6.25, 5.75 to 6.25 is where Logan's research says. And he highlighted that we have 2 years of data highlighting that that's the sweet spot to bring back demand. Also, it's where builders are buying rates down to facilitate purchases. So I agree with that. Again, I think for 2025, we're going to be right around 5.8 will be kind of the low watermark for the year. So we shall see. Finally, NAR chief economist Lawrence Yun. Man, he could not catch a break. He was the chief economist heading right into the GFC, and I just remember reading he's down another 10%, down. It was tough, but thankfully we are no longer there. He is talking about 6% mortgage rates being the new normal, which again, something that I've been putting out there. Again, I don't see demand jumping big time. I think we'd be lucky to get 4.2 million transactions next year. Again, the only way through this is to get through it. We need wages to continue to increase, prices to be flat, rates to slowly go down, and we will bring in affordability back to the housing market. The last thing I am really thinking about and concerned about, we've talked about this 3 or 4 times in the last 6 months, is the equity sitting in housing. I read another report this morning that the average equity in a home today is $400K. Now, of course, you got to be careful with the word average, right? That's going to be very skewed by California, New York, high-priced areas. But even if you take it down to 200 grand, let's just say the median's 200, and I don't know the median. This report was all average, but let's say the median's 200. My concern is rates fall to some level, let's call it 5.8, and homeowners start tapping that equity, and maybe they pull out 50%, they pull out 100 grand. If this happens, in any kind of consistency, kind of the cash out refi, that's a lot of money circulating in the economy. I mean, there's trillions and trillions of dollars in potential equity extraction that could keep this no landing, economy going. Also could potentially reignite inflation if we are not careful. But yeah, this is something I will be watching, especially next year as rates get to, sub 6%. And then the last thing I want to do is I want to congratulate a brand new school member, Radek. Radek, thank you very much for joining. Also, Radek, props, man. You came in and already put up your first post. You've already put up your first post introducing yourself. That's a great way to go. A couple other things about school. Did you know that my one rental at a time school costs 67 cents a day? 67 cents a day. 2 quarters, a dime, a nickel, and 2 pennies. 67 cents. That is the price of school to get in a community with nearly 300 amazing other individuals. You get 3 weekly accountability groups. Join the one that fits your time. I did make a slight change to school to encourage comments, thumbs up, all of that. I took the creative finance, the 3-hour course or 6-hour course from Ty. That is now available at level 2. So when you join, you are level 1. I think if you make 5 comments or something, you become level 2. So the creative finance will unlock at level 2. And then the 10-week boot camp, my $1,000 10-week boot camp, it is still free. I'm not charging for it, but it unlocks at level 3. So again, you have to make some comments and whatnot. I got this from Andrea, how she's killing it on the school platform, is unlock some of the great value at different levels. So again, it's all there. It's not hiding. You just got to get to level 2 for creative financing and level 3 for the 10-week boot camp. It's time to join, folks. 67 cents a day, 67 cents a day. Get in a group with 300 other people encouraging you, asking questions, networking. Join the accountability groups. Get around 15, 20 other people weekly and just see how amazing school is. All right, folks, take care of yourself. Be careful out there. 45% of Americans are going to run out of money in retirement. That's frightening. Take care, everyone. Bye.